Okay. Thank you everyone for joining today's webinar organized by the IIC and the Europe chapter of the IIC. The IIC, for those who don't know, is the world's policy debating platform for converged communications industry. It gives innovators and regulators a forum in which to explore, debate, and agree the best policies and regulatory frameworks for wider societal benefit. And if you don't know about the IIC, I would encourage you to take a look at the IIC website after this webinar. And if you're not a member yet, to consider joining the IIC, as it gives its members a voice through conferences, symposiums, and private meetings, as well as webinars. And today's webinar will be is indeed about incentivizing investment. Let me start by introducing our panel of distinguished speakers. If we could go to the next slide, please. Apologies for it.
Francesco, you can flip the slide on.
Yep, okay, here we are, thank you. So today we have the privilege of having as the chair of our webinar, Jeremy Godfrey, Commissioner of the Commission for Communications Regulation, ComReg in Ireland, as well as Vice Chair of BEREC. And also Emily Clark, Chief Economist at British Telecom, BT, Felipe Flores-Duncan, Partner at Oxera Consulting, Luigi Minerva, Senior Telecoms Analyst, Equity Research at HSBC, Mark Williams, Managing Director, Berkeley Research Group, UK, Tiziana Talebi, Regulatory Affairs Officer at Fastweb, and then you have me, a partner at global law firm Squire Patton Boggs, as well as chair of the IIC Brussels chapter. And without further ado, let me hand over to Jeremy to introduce today's topic.
Thank you very much, Francesco. You can wave at me, Francesco, if you can hear me.
Yes.
Okay, great. Everyone can hear. So welcome everybody to today's event. It's always a pleasure to be asked by the IIC to assist with a webinar or a meeting. I think when I joined the European telecommunications regulatory community 7 years ago, I personally learned a lot from attending IIC meetings, especially the regulatory forum, the International Regulatory Forum. And over the last 2 years, BEREC has been very pleased to collaborate with IIC in organizing a joint conference to mark BEREC's 10th anniversary last year, and a webinar earlier this year about how the European telecoms industry had responded to the challenges of COVID. To just give a very brief introduction to the topic, because I don't want to take up time that is better spent with our other distinguished speakers. Of course, investment in and take-up of very high-capacity networks is a critical objective of the Code. In fact, it's now become a statutory legal objective for the Commission, for Member States, for national regulatory authorities, and also for BEREC itself. So everybody is supposed to be thinking about those things. Perhaps the experience we've had over the last few months of responding to the COVID emergency, supporting work from home, supporting learning from home, supporting social life from home, has highlighted not only the importance of telecommunications and advanced telecommunications, but the very real importance of universal service provision. So that it may well be that there's been a far bigger gap in the experience of lockdown between people who have no broadband or inadequate broadband and those who have NGA broadband as opposed to the difference between people who have very fast broadband, fiber-based, versus NGA. So potentially in the next few years, there will be as much importance put on spreading coverage of adequate broadband as there will be on getting as much VHCN as possible. The code itself has a number of provisions intended to enhance investment in VHCN, particularly those that set out structural approaches as an alternative to the ex ante behavioral remedies in the traditional SMP regime. So those are things like wholesale only, co-investment, and there are also provisions about voluntary separation and voluntary commitments. So some of the questions I think it would be really interesting to explore today is, first of all, is anybody interested in those provisions in the code, or are they actually too complicated by the time they've gone through the legislative sausage machine? Have they ended up so complicated that nobody's really going to be able to take advantage of them? Another question is, should NRAs consider other structural remedies, maybe using the commitment provisions or the voluntary provisions? Will those prove more flexible and useful? Then there's a question about, are other aspects of regulation more important or as important, such as how will we approach copper switch off? What should the pricing remedies be for fiber? One might also ask whether regulation is really that important anyway. There are many things that are not to do with regulation, such as patterns of demand, such as the availability of civil engineering infrastructure as a result of historical decisions made over many decades, such as the prospect of competition from fixed wireless operators, maybe from LEO satellite operators, maybe from people using other forms of civil engineering access. There are questions about the Broadband Cost Reduction Directive. Does that need to be reviewed? How will that change? And then there always will seem to be a divide between areas of any country which can be served on a commercial basis and areas which can't. So there's a question about what is the ongoing role of state aid in making sure that we don't create or that we rapidly fill a new digital divide. So those are maybe some questions that we can bear in mind as we're hearing from the speakers, and we'll return to those after everyone's made introductory remarks. So each of the speakers is going to speak for an average of between 5 and 7 minutes each. Some will have slides, some will not have slides. Then after each of the speakers has made their introductory remarks, we'll have a panel discussion. I'll pose some questions, but you are all in the audience really welcome to pose questions yourself. If you'd like to do that, if you wouldn't mind using the chat function, and if you send your questions either to all attendees or at least to the host, panelists, and presenter, then we'll see them, and I will read out questions and put to the panelists. Don't feel you have to wait until all the panelists have spoken before you ask questions. If you think of a question you'd like to be asked, just type it in straight away, and we'll save it for the Q&A session. And with that introduction, I'll hand over to Emily Clark from BT to give us her opening remarks. Emily, the floor is yours.
Thank you, Jeremy. I assume you can hear me?
Yeah.
Thank you. I wanted to use the time I have to talk about investment risk. Much of the investment in fibre and 5G that's coming will be commercially funded. At BT, we're planning very significant investments in both, including upping our fibre coverage to 20 million premises by the mid to late 2020s, a recent announcement from us. But capital-intensive investments like this, with long paybacks, are risky, and firms that are investing or planning to invest face a deteriorating economic climate. So really the balance of risk and reward is critical to investment incentives, and naturally firms are looking at commercial structures which can mitigate risks and the code provisions try to encourage this by adding the enticement of a break from regulation for the arrangements which qualify. But I think one point I wanted to draw out was whether or not operators use those structures, regulators will still need to engage with investment risks. Now, clearly, if infrastructure competition takes hold, then operators will decide on investment and rollout, knowing that returns and risks will be market-driven, as typically happens in the mobile sector. But where competition is uncertain, operators like BT face a further risk that regulation will be imposed some way down the line. And that adds a regulatory risk to the spectrum of commercial risks which affect expected returns. Now, in the UK, we've got the concept of the fair bet, which means, in a nutshell, ensuring that commercial bets taken by investors are fairly treated by regulators, or in practical terms, ensuring that any upsides, if the investment is successful, are not unduly curtailed by regulation in a way that might jeopardize the investment if that regulation had been known at the outset. So a bit of a mind bender, but simpler maybe to think of it as making sure that upside outcomes are not truncated to the point that the investment wouldn't have been made in the first place. Now, that doesn't mean that returns are guaranteed, but it does mean that a regulator would indicate upfront the project returns that an operator would have the opportunity of retaining. And I think Felipe will describe how this is done, so I'm not going to steal his thunder, but I can explain how important it is for firms like BT who are developing business cases in order that we and others are able to assess expected returns. I think it's widely understood that fibre investment is risky. Yes, steps have been taken by regulators to encourage investment, notably in the UK by reining in the very significant price cuts in wholesale prices that we've seen in recent years. But risks remain. We have uncertainty about the take-up of higher speed services, which are susceptible to the economic cycle. Deployment costs are uncertain. And Jeremy mentioned rival technologies like 5G fixed wireless access and low Earth orbit satellites. I noticed that the UK government, for example, is taking a stake in OneWeb, a satellite operator. So an interesting development there. Capital commitments are significant and they can be sunk before much is known about risks. And as I mentioned before, paybacks are very long. So faced with these risks, investors reasonably want to know their opportunity to make returns. Now, one answer to that might be whatever the competitive market will allow, and that would be familiar territory for an operator like BT with a large mobile business. But in fixed, the answer is what the market and or regulation will allow. BT is already subject to some regulation of its fibre services, and there could be more, and other operators could be drawn into regulation further down the line. So all operators need to know how risks will be taken into account if regulation is imposed in the future, and they need to know that up front when business cases are being developed, not wait 10 or 15 years to see what happens. And we have some experience of the wait and see approach because BT's fibre to the cabinet investment was eventually price regulated approximately 10 years into the project lifetime. And Ofcom certainly checked at that point that BT would still make lifetime returns which were in line with the risks. So it did honour the fair bet in that sense. But it proved to be difficult to fully reconstruct the risks as seen at the project outset. And one of the problems is that it's difficult to be impartial when you're judging the risk of an investment that's turned out to be successful. I think behavioural economists would probably have a name for it. The best I can come up with is retrospection bias. And there was a wonderful quote from Virgin Media at the time that FTDC regulation was being debated in the UK that went along the lines of, it's like judging whether the odds on a horse at the Grand National were fair based on the hindsight that it was, in fact, first past the post. Like most governments, the UK government is very keen on fibre investment. The faster and the bigger and the better. So much so that we've seen government officials grapple with the concept of fair bets because they clearly see the connection with investment incentives. And they concluded that firms making large and risky investments should have confidence that any regulation will reflect a fair return on investment in line with the level of risk incurred at the time of making the investment decision. Now, turning to co-investments and other schemes for sharing costs and risks, these obviously provide commercial structures for mitigating investment risk. But for operators who participate, the key question remains, what is their opportunity to earn returns commensurate with the risks borne, albeit the risks are distributed more widely? And also, how does this compare to their opportunities if they go it alone, assuming that the fair bets are honoured? Now, clearly, an extended period of free of price controls is appealing, and it certainly helps with regulatory certainty. But the qualifying criteria, depending on how they're implemented, will affect the balance of risk and reward, and therefore the incentives to invest through those structures. So take, for example, the requirement to let parties join the co-investment later. Now that clearly dilutes the incentives to share risk early when risks are higher, unless the terms for the latecomers are less favourable. But how much less? I would guess you'd need to have a handle on investment risks to answer that, so that there's an objective basis for different prices or other terms. And again, I think Felipe might have some clues for us on how that might be done. I think I'm also looking forward to hearing what the lawyers have to say today about how these schemes sit with competition law considerations. For a large operator like BT, it goes without saying that any arrangement on the spectrum of risk-sharing schemes must be compliant with competition law. But our regulator in the UK has given this even more emphasis by proposing an extended review process to allow it to review wholesale pricing structures and decide whether to intervene using its regulatory powers. And this is very much geared towards the protection of nascent competitors, which we completely understand, but it does highlight the tension between schemes which might be devised to really drive investment and which are desired by large customers in many cases because they want stable and low prices for new services, and concerns about the impacts on infrastructure competition. We very much welcome the work of SAR in shining a light on the trade-offs so that policy choices can be made more consciously, because one of our concerns is that schemes which are adjudicated against regulatory criteria rather than competition law criteria might be more susceptible to protecting particular competitors rather than the process of competition, which of course competition law is very careful to guard against. Plus, you find regulators having to adjudicate on the level of competitive impact which is acceptable, and that is also tricky without the effects-based tools offered by competition law. So just to sum up, many operators like BT are contemplating vast and risky investments to deliver fibre and 5G. We'll compete fairly with others, and when we do, and regulation may fade away in some areas. But because we can't rule out regulation, we need to know now what this might look like, not price levels and not guaranteed returns, but just the opportunity to keep some of the rewards for taking risks where risks are found. And if co-investment is to work, it still needs to be mindful of the payoff to taking risks and leave them in play for early movers. And finally, I do hope that the co-investment and infrastructure sharing, more generally, the debate about those will foster a more productive debate about potential trade-offs, so that we can be clear on the sweet spot where benefits of those arrangements are maximised and any anti-competitive effects are minimised. So I'll stop there and hand over now to Felipe.
Okay, Felipe, if you'd like to take the floor, can I remind you to unmute yourself and turn on your camera if you're using it. Thank you, Felipe.
Thank you, Jeremy. I'm going to share my slides, so I won't turn my camera on so as to not distract the audience, and I will turn it on maybe later when we have the Q&A and the discussion. Can you all hear me well, right? I will take that as a yes.
Yeah, yes, we can.
Perfect. So as Emily said, I'm going to be talking to you about how to take account of risk in the regulatory framework. And risk is extremely important. The concept of risk, grappling with the concept of risk, is extremely important because the code, the new European Electronic Communications Code, is since the 2 decades that we have the European Telecom Framework, probably more pro-investment than it has ever been. And it has many references to terms such as fair and reasonable returns, pricing flexibility, and taking appropriate account of risks. Here are just a selection of quotes that I've picked up from the code. In Recital 180, it talks about if there's going to be a price control, authorities should seek to allow a fair return for the investor, taking account of the fact that demand is uncertain at the time the investment is made. There's also reference to the fact there is uncertainty regarding the rate of materialization of demand, and therefore the need to have a degree of pricing flexibility. One of the main objectives, which has been upgraded, it's always been an objective, but has now been upgraded as a main objective of the framework, is to promote efficient investment that takes appropriate account of the risk incurred. And we also have, as has been referred a number of times, new provisions. So, for example, wholesale-only business models, it is envisaged that they will be subject to less intrusive remedies, and access obligations will be subject only to fair and reasonable pricing, so no strict price controls. And similarly, co-investment schemes would also be subject to fair, reasonable, and non-discriminatory terms. And as Emily was alluding to, they will be allowed to take account in their pricing of different levels of risk incurred by different co-investors, in particular those who invested early versus those who invested late. So as we can see, the concept of risk is pretty much central to a lot of these new provisions and a lot of the main objectives of the code. So it's really important that we have a very good understanding, in particular regulators need to have very good understanding of what are risks, what do investors require compensation for. So traditionally, we're all very familiar with the concept of the weighted average cost of capital, which is the traditional form in which regulators have rewarded investment in charge controls. However, this only measures non-diversifiable systematic risk, so more technically, the asset beta parameter in the cost of capital calculation, which captures how returns move with macroeconomic conditions, business cycles, geopolitical issues. But there is another category of risk, which is extremely important for investment decisions, and that is project-specific or firm-specific risks that contribute to the volatility of cash flows in an investment. There's demand risk, the risk that costs might turn out higher than you not originally envisaged, technological uncertainty, and competition risk, in many cases driven by regulation itself. It's increasing the risk of end-to-end competition. So these factors, these non-systematic factors, non-systematic risks, are also heavily affect investment decisions. And regulators recognize this. I mean, ever since the 2010 NGA recommendation started talking about the concept of the risk premium, many of these risks have been recognized as important and needing to be dealt with, but there is no commonly accepted approach for how to do so. I've seen regulators in different countries try different approaches, some more complicated than others, but there's no common approach for how to capture these risks in a holistic way, and this needs to change given how central this concept is in the new code. So what I'm going to talk to you about now is a particular framework that we've been working together with BT to implement in the UK telecoms regime. And before I give you a little bit more of the details how it applies specifically on fiber investments, I just want to introduce you to the topic of non-systematic risks by playing a hypothetical game. And you will be the judge as to whether this game is fair or not. So the game plays as follows. You will hand over to me 100 euros, and I will toss a coin, and there's a 50% chance that it lands heads, and I will give you 200 euros. But of course, it's also a 50% chance that it lands tails, and I will stay with the 100 euros, and you will get nothing in return. The expected return of this game is you will get 100. If we play it sufficient times, you will get your 100 back. So you could say that this is a fair game. If you have a bit of appetite for risk, you would probably play this game. And there will be scenarios in which you earn 200 euros. That's 100% return on your 100 euro investment. But what if I turn around and say, you know what, I think 100% return if it lands heads is just too much. I mean, that's a lot of money. It's, 100 euros more than what you invested. So I'm actually going to 150. I think that's fair. You still get nothing if it lands tails. Now, the expected return here is now 75. Word of advice, this is not a fair game, and you should probably not play it. Now, this very simple game, this very simple concept is, in a way, exactly what's happening when one thinks of large investment programs in new assets subject to demand, cost, competition risk. One could think of the 100 euros that we're putting up front as the cost of capital, and the different scenarios as to whether you get 200 or 0 as to the potential outcomes of that investment. Demand take-up could be pretty good, or it could all go wrong. So we translate this very simple game and apply it to the investment in risky assets, to the fair bet principle. Here I'm kind of describing how Ofcom in the UK has stated what the fair bet principle is, and it reads as follows. An investment is a fair bet if at the time of investment expected return is equal to the cost of capital. In our coin toss game, this means that the expected return must be equal to the 100 euros you put up front. And ensuring that the fair bet is satisfied may entail earning returns above the cost of capital to compensate for the additional downside risks that were faced when the investment was made. So in our coin toss game, this means earning returns of 200 or in excess of 100 when things go well, to compensate for the fact that if it lands tails, you will not get anything back. So if you think of the potential outcomes of a fiber investment program as lying along a distribution, returns could be low, lifetime returns could be high, but the expected return shown here as the green line is somewhere in the middle, potentially above the cost of capital. The fair bet requires that we earn returns, that this investor earns returns above the cost of capital. And how much higher? It needs to be sufficiently high. In this case, we're showing an IR cap to the right-hand side of this distribution, such that when we recalculate the expected returns of this investment, which are going to fall because we know that this investor can no longer earn returns in excess of the cap, so therefore its expected returns are going to fall. Expected returns don't fall below the cost of capital. So the fair level of returns in this case is a price control that caps returns at the IR cap, such that the investor is expected to earn returns that are at least equal to the cost of capital. So I mean, we've kind of built it up little by little. It's very similar to a coin toss game, but obviously there are many more factors that need to be taken into account, and the analysis is more complex, but the basic logic is the same. This analysis allows us to estimate a level of returns that below which an investor will not be earning fair and reasonable returns. So this framework allows us to operationalize the concepts in the code regarding fair and reasonable returns, taking account of risks. It is very important, as Emily was saying, that the analysis is done upfront. Today, when we are all aware of the different risk factors and the different possibilities for different scenarios for how this investment might turn out, it's very important that the analysis is done upfront in order to avoid, as Emily called it, retrospective biases and judging the investment by how it actually turned out to be rather than how it was perceived at the time. And this framework can also be applied if the investment proceeds in stages or in tranches, right? Obviously, the earlier tranches, when the risk is highest, may carry a particular might be expected for later tranches of investment when the risk starts to diminish or decline. So this is the basic concept of what the fair bet is, but it still doesn't answer the question when and how should price controls be imposed. The code allows for and probably encourages a period of pricing flexibility in order for these risks and uncertainties to play out. So price cap regulation is only going to be needed if lifetime returns of the investment are forecast to exceed the fair bet or the fair and reasonable return, the IRR cap. So it is important for investors to be monitoring and tracking and projecting lifetime returns of the investment. Now, over the first 5 years, one can start to see risks crystallize and the returns of the investment starting to go up. But there's still a significant amount of uncertainty. I mean, the investment could still turn out to be a pretty poor one, or it could be a pretty good one. If the investment is going to be the return of the investment is going to be below the IRR cap that we calculated, then price cap regulation will not be needed. Whereas if investment is forecast to be above the cap, it is only at this point that we would need price regulation to make sure that the returns are in line with the fair and reasonable returns that we've calculated. And to conclude, just a couple of points on wholesale-only business models and co-investment. What I've given you is a framework to estimate fair and reasonable returns. So what would be the fair and reasonable returns for wholesale-only business models as envisaged by the code? Well, in principle, I would argue that it has to be the same methodology that I've just presented, except for the fact that regulators might exercise judgment and potentially allow for returns that might exceed the fair bet cap that we've just estimated. After all, the code's objective is to treat these wholesale-only business models more lightly, so returns need to be at least as high and probably higher than the fair bet approach that we've just estimated. And finally, when it comes to co-investments and the need for the co-investors to set the rules of participation in such a way that it ensures that late co-investors pay a risk-reflective price, the methods and the methodology that I've just described here can be used to calculate that price differential. You know, one will need to estimate the price for joining the scheme at the start of the co-investment scheme, and then at a future date when risks have fallen and the value of the co-investment scheme is higher, and the difference in value can be then expressed as a different fixed fee to join the co-investment scheme. While still ensuring that the access price per line that everybody pays to be able to provide broadband services downstream is the same in order to avoid competitive distortions downstream. So that's all I wanted to share with you now, and I look forward to continuing the discussion and conversation in the Q&A.
Sorry, I don't know if I was on mute myself. I was going to hand the floor to Luigi and ask Luigi if he wouldn't mind unmuting himself and turning on his camera if he would like to. The floor is yours, Luigi.
Yes, thank you, Jeremy. I hope you can all hear me fine.
Yes, we can.
Yes. Okay, great. So thanks also to the IIC for inviting me. So in my section, I will aim to provide a financial markets view, focusing on how provisions in the code, such as co-investment, fit within the context of the investment case of European telcos. So I think, firstly, we should set the background, and the first point to make is that European telecom stocks listed on the public markets remain very much unloved and out of favor with institutional investors. Just a few numbers that really speak for themselves. Over the last year, the general European index has lost 4%, European telcos have lost 7%. Over the last 3 years, the general European index has gained 4%, and the European telcos have lost 15%. And finally, over the last 5 years, the general European index has gained 10%, and European telcos have lost 27%. So that's a 37 percentage point underperformance over the last 5 years. So now in the investor's mind, there are broadly two issues with the investment case of European telcos. Now, the first one is that there is no revenue growth. So data traffic continues to grow at significant rates, connectivity is in high demand, but telco operators struggle to translate this in revenue growth. The second issue is that dividends are not as sustainable as one would hope. Now, investors look at telcos because of its defensive characteristics. Operators aim to protect free cash flow generation in order to protect the dividends they pay to their shareholders. And CapEx here can be useful. They can be treated as a discretionary item and can, to some extent, be adjusted accordingly. So, for example, the business case for 5G remains, as we stand, quite dubious, and some operators may decide to spread 5G capex over a longer period of time. But ultimately, if revenues are under persistent pressure, then the free cash flow would decline, and dividends would have to be cut accordingly. So what I will discuss here is how some of the provisions from the code, such as co-investment, fit in the context of these two key challenges for European telco investors. So first question, can co-investment help making dividends more sustainable? Second question, can co-investment somehow help the sector regain its ability to grow revenue? So the first question is relatively easier. Co-investment can help operators share the cost of network deployment. So think, for example, at the French market. The network characteristics there require operators to deploy fiber to the premises. Fiber to the cabinet is not a viable option. The cost of a standalone fiber to the premises deployment would be very punitive, but the co-investment scheme put in place by the regulator RCEP allows to deploy FTTP in a more manageable way. So we could consider co-investment as an additional tool in operators' hands to try to manage CapEx and protect free cash flow generation. Co-investment in itself is not enough, is not sufficient, but it could help protecting dividend. And it could therefore help regain investors' trust in the sustainability of dividend policies. The second question, so if measures like co-investment can somehow help the sector regain its ability to grow revenue, it is a much more complicated one. Now, the short answer could be that it very much depends on the market structure. So I will start by looking at fixed line and then move on to mobile. In fixed line, if the aim is to reintroduce some inflation, some pricing power in the system in order to gradually bring back revenue growth, I think co-investment is probably an inferior solution to a traditional wholesale access model. Now, in the traditional wholesale access model, the access terms would generally follow the principles outlined in the non-discrimination and cost methodology recommendation. Access seekers have to incur in a regular monthly per household wholesale cost, which never goes away, and therefore instills discipline in the retail pricing strategy. Investors should, in our view, like wholesale-based market structures because of the relative stability and gradually inflationary nature of the fixed line market.
Luigi, could you do about 1 more minute, please?
Yes, sure. Maybe a couple, Jeremy, sorry. So one drawback of the co-investment approach is that when involving operators of different scales and dimensions, it can be negative for the larger operator, as it implies it's sharing some of its scale advantage with smaller players. No, and perhaps I can go back more on this in the Q&A. Then moving on to mobile, in recent years, there has been an acceleration in network sharing and co-investment agreements. So network sharing can certainly lead to a lower cost of deployment. However, in terms of its impact on the sector investment case, once again, I believe it's very much dependent on the market structure. In a fragmented market, typically in Europe, we have 4 to 5 mobile players. The savings and benefits of network sharing are likely to be competed away and lead to further deflationary pressures. In fact, players are likely to use the additional cost flexibility to be more price aggressive and try to win market shares. So this outcome would be even more exacerbated when network sharing agreement involves operator of different scale, with the larger player ending up sharing some of its scale advantage with the smaller player. For this reason, I would argue that network sharing is no substitute for in-market consolidation, and it is actually an inferior solution to outright consolidation. One final point worth making is that while listed European telcos have been struggling to win support from public equities institutional investors, there is an abundance of private equity capital willing to invest, particularly in telco infrastructure. And private equity have shown great appetite for assets like towers and metropolitan fiber networks. So these are normally less regulated assets, delivering resilient revenue growth and defensive and predictable free cash flow. And this makes the whole difference. Thank you, Jeremy. Jeremy, I think you're on mute.
Thank you very much, Luigi. That was, I think the full extra 2 minutes was well worth listening to. If I may now pass the floor to Mark, again with my usual recommendation that you unmute and turn on your camera if you'd like to do so. Thank you, Mark.
Okay, hello everyone, thanks Jeremy. I'll leave the camera off because I've got some slides, so my face will be a distraction, but I'll put it on for the Q&A. So I'm going to talk about the competition and the competition regulatory implications of co-investment. And the first thing I thought we should note is, although there has been a lot of focus on co-investment as part of the Electronic Communications Code and in the run-up to it, it's actually not a new idea, and the discussions around co-investment go back many years, really from the early days of the transition from copper to fiber in the access network, and there was a lot of discussion around how to get joint ventures into co-investment. But because we've seen a flurry of deals over the past 10 years, and it's now got into the code as a concept, then there's been a lot more scrutiny of the competition implications of it and the regulatory implications of it. And I think that will continue as the number of deals increases. So my starting point for thinking about this is to make sure that we have a clear view about what we're talking about when we refer to co-investment. It has one label, but actually that label co-investment covers a very wide range of different type structures of deals. And we developed a simple classification of these deals into three groups. There's what we call a joint venture model, where essentially you have two competing operators who form a horizontal agreement, what's also called an upstream horizontal supply agreement. So they do a joint venture together to supply themselves in the downstream market and also to supply third parties. So that's the first type, and that is a joint venture model, is one that we quite often think about when we talk about co-investment. The second one, which I would argue is actually more common in recent years, is what we've called the reciprocal access model. Now, the essence of this, which we've seen in fixed markets and we've also seen in mobile infrastructure, is where two or more operators form an agreement. They build infrastructure in different parts of the country, for example, or different parts of the city, and then they give each other reciprocal access to their own infrastructure. So it's not actually a joint project in the sense that they're jointly co-investing in one network. They're building two networks, but they're just giving access to each other to it. So that's the second type. And then the third type is what we call the one-way access model, where this is a vertical arrangement in which one party builds network, but signs some kind of a long-term contract with a buyer, including its downstream competitors, as essentially as an offtake agreement. And that is in effect a joint venture, because you are reducing the risk of the investments by the means of this long-term contracting arrangement. So what are the implications for investments? Well, as Luigi's mentioned, they can have a very significant effect on the amount of CapEx that each operator is required to invest in order to be able to hit a certain level of coverage. But each of the different types of co-investment model has different implications for the investment incentives. So horizontal co-investment models with joint ventures, although they appealing in their simplicity, they can actually be very difficult to organize. And there are few examples of where this type of investment arrangements, this type of joint venture, has been successful, primarily because the parties are usually competing in the downstream market, and therefore they have conflicting incentives to cooperate. Reciprocal access projects are easier to set up because each party is building and operating their own network separately. So there's not a much smaller reduced requirement for joint management and investment arrangements. So you see more of those, especially in Southern Europe. And then these vertical arrangements that I mentioned, this is actually a very common arrangement in submarine cable financing, where investors sign offtake agreements where buyers get discounts for pre-purchasing capacity before the cable's even been built. So there is quite a lot of experience of that in the telecom sector. And you're seeing it increasingly in the terrestrial fiber networks, where both challenger networks and incumbents are trying to sign bespoke contracts with buyers in order to reduce the risk of the upstream investment. And so what are the competition implications of that? Well, in the horizontal agreements, these are joint production agreements, and depending on the terms of those agreements, they can serve as a mechanism to soften competition. If it's through a joint a horizontal agreement, if the parties that are competing in the downstream market agree to a mutually high price as the exclusive input into those downstream products, you're effectively setting a baseline price, which then which softens competition in the downstream market. But it really depends on the details of those agreements and what it is that the parties are selling to each other or selling to themselves through the vertical arrangements. They can also form a mechanism for information sharing, and this is one thing that competition authorities and regulators have looked at, both in mobile and fixed arrangements. In the vertical agreements, there's potentially significant exclusionary effects depending on how these contracts are designed. There is a concept of buying off a competitor, so where an incumbent operator, rather than seeing an entrant, can build a rival network, which would result in potentially quite intense competition throughout the value chain. Instead, they sign a deal, an offtake agreement with that competitor, and in order to avoid them investing in upstream infrastructure. So that's the theory. In practice, regulators and competition authorities have been quite positive towards co-investment, both in mobile and fixed. They've typically seen the benefits of investment outweighing and facilitating entry into the market, both upstream and downstream market, as outweighing the potential for softening of competition. They also see these joint ventures existing within the shadow of a regulated incumbent in most cases. So that naturally provides a cap on the negative effects, potential effects of any kind of horizontal agreement. So just to finalize, what are the key things that competition authorities and regulators should be looking at when they are considering these joint ventures? First thing is, how close can the sharing arrangement get for the effects begin to outweigh the benefits? And that's both internally within the project, but also considering the external market within which the joint venture is operating. That's the first point. A second key issue, which I think is going to be extremely important going forward, is how to balance the desire for incumbents to enter into co-investment deals while also avoiding exclusionary behavior or exclusionary effect through these deals. And we've seen some cases in Germany where regulators have required incumbents to change the terms of their vertical contracts. We've also seen examples, say, from the UK, where the regulator's been skeptical about or it's limited the freedom of BT to enter into bespoke contracts with downstream buyers because they're concerned about potential exclusionary behavior. And then finally, medium-term implications. How should these co-investment structures affect key regulatory issues like market definition and decisions on SMB? I mean, one logical consequence of a co-investment deal that creates a competitive market within a region or within a city would be, for example, deregulation of the incumbent. And so these issues, I think, are just the early days of regulators getting a handle on these issues, but these are going to be the primary issues going forward in the near future. Jeremy, over to you.
Thank you very much, Mark, and thank you also for keeping to time. I'm now going to give the floor to Francesco from Squire Patton Boggs. And Francesco, again, just a reminder to unmute and turn on your camera. Thank you very much, Francesco.
Thank you, Jeremy. Hopefully you can hear me. I will not take you up on the offer to turn my camera on because I find that the picture that you have on screen is more flattering than my post-lockdown current look. But I will turn the camera on when we go into the Q&A session. In the next 5 minutes, what I would like to offer is some additional thoughts from a private European competition law practitioner's point of view. And the three main points that you may perhaps want to take away from the next 5 minutes are the following. The first one, and it picks up on something that Emily has alluded to, the interplay between sector-specific rules and competition law in assessing co-investment arrangements and network sharing arrangements. I find that these two rules, although different in many respects, are complementary tools. And when we look at their practical application and the practical application of the assessment criteria for this type of arrangements, they do share many common features. The second main point is that authorities, both NRAs and competition law authorities, are concerned with a balancing act, or as has been called throughout this presentation, a trade-off between the competition law risk and investment efficiencies. And so what it comes down to, and this is my third point, we're all focused in finding remedies to disentangle the efficiencies from the potential anti-competitive effects. And looking at the remedies that have been secured successfully by parties that have persuaded competition authorities and NRAs alike to approve the network sharing and co-investment arrangements. The remedies under competition law have so far mirrored sector-specific regulation, and I can give you an example of that. So just quickly zooming through the slides to keep with time. Competition objectives are embedded in the Electronic Communications Code, and Felipe has recalled the objectives that NRAs must promote when through network sharing and co-investment arrangements. BEREC has an important role. It is working on guidance on the assessment of co-investment, but it has produced guidance and a common position on the parameters for NRAs to consider when assessing network sharing arrangements. And in going through these criteria, competition lawyers will find them very familiar. So NRAs will look at the structure of the market shares, the number of operators involved in the sharing, the technologies involved, the geographic scope, the time frame. They will look at the counterfactual, what would happen absent the proposed arrangement, and with a clear indication that what you need to look at is whether infrastructure-based competition would be feasible at all absent the arrangement. And clearly where that is not feasible, you would find that there is no harm to competition under the counterfactual. The common position also says that passive sharing is generally less problematic than active sharing, and this is perfectly consistent with the decision-making practice of competition authorities. Information sharing is another important element, and it needs to be limited to what is strictly indispensable and also limited to the persons that need to know competitively sensitive information in order to make the proposed arrangement work. And then you need to look at the structure of the arrangement. Looking now at how a competition authorities would consider this type of arrangement, you have exactly these three elements. You have the market context, the counterfactual, and the structure of the co-investment. And this is all to determine whether you're looking at cooperation between non-competitors, cooperation between actual potential competitors, or in fact a full merger. Again, the European Commission recognizes, very much like the code, that network sharing can have pro-competitive effects. And I think that goes, although we don't have a similar official statement with regard to co-investment in fiber, I think the same logic clearly applies. At the same time, there are potential anti-competitive effects, and they concern the reduction of infrastructure of competition and innovation, the foreclosure of competitors, the exchange of competitively sensitive information. So looking at the trade-off and what are the factors that could increase the competition risk. As competition law practitioners, we often look at all of these elements. So clearly, if you have joint market shares, the higher the joint market shares, the greater the risk. The higher the commonality of costs, the higher the risk. The greater the exchange of competitively sensitive information, the greater the risk. And also, the closer the relationship between the parties, which can go from a more loose joint production to a full merger, the greater the competition risk. And as I said, from the outset, competition authorities, NRAs, and the parties to network sharing and co-investment arrangements, as well as their advisors, we're all looking at a trade-off, a balancing act between the potential anti-competitive effects and the efficiencies inherent in this type of arrangements. And so when defending or advising this type of arrangement, what we need to try to look for are remedies that would disentangle the efficiencies arising from the arrangement from its potential anti-competitive effects. And this is evident in many of the cases and the body of case law that has emerged through the years, both in connection with network sharing and fewer, but some also in connection with co-investment in fiber. And perhaps to set the scene for what Tiziana will be saying next, I just wanted to mention very, very quickly two examples. The first one is the co-investment between TIM and Fastweb. This was an example of a non-full function joint venture and therefore a looser form of co-investment. And the national competition authorities in Italy found that there were certain competition concerns that could only be resolved through a number of remedies that very much mirror the conditions for approval of co-investment arrangements under the code. Similarly, another example from Italy, the network sharing arrangement between Vodafone and TIM, and that case is different because it was considered by the European Commission to be a full function joint venture and therefore subject to European merger control. Again, the Commission found that there were the competition concerns that I was alluding to before, in particular in Italian municipalities with more than 35,000 inhabitants, and only cleared the deal subject to a number of remedies that again mirror the code in terms of the conditions for open access.
Okay, thank you very much, Francesco, and thank you for speeding up towards the end. And it's a great segue into Tiziana's presentation on having heard from a lot about the framework. We're now going to hear a little bit about what it means in practice in Italy. So Tiziana, with video if you like, and audio definitely, the floor is yours.
Thank you, Jeremy. I've listened carefully to all the presentations that have been made before and which I found very interesting. And there's been a lot of discussion on the implications of co-investment with regard to the objective of promoting investment in NGA networks in general. I think the underlying assumption is that there is a trade-off between co-investments and competition, and therefore the fact that incumbents in particular would be incentivized to invest in NGA if there was less competition, or if they would be allowed to increase wholesale prices and actually have, as I said before, less competition due to the fact that maybe wholesale prices are higher or even just deregulated. And I think this doesn't necessarily need to be true. We have a lot of examples. I think Italy is a good case. It's an interesting case because we have had a whole lot of co-investments, and not necessarily, and all of these, in my opinion, have been competitive, meaning that all these co-investments have not hampered competition. Actually, they have increased the level of competition. And they have just basically proved, confirmed actually once more that actually the true driver of investment is only competition, especially infrastructure-based competition. So co-investment in this scenario are basically a need, a tool which operators have to reduce their costs and therefore have greater efficiency. But looking at the cost side, not rather at the market side or the retail side, which still can allow for competition on the retail side. The other comment I would like to make, is that, I'm sorry, I need to plug my computer, otherwise it would be, just a second, it will go off. Okay. Sorry, I hadn't realized the computer was, okay, sorry. Okay, so that's, as I was saying before, the co-investment sometimes is also in the code, is before to maybe deregulation, and this would be an incentive for the incumbent or operators to invest. As I said, this doesn't necessarily need to be the case, because, for example, in Italy, co-investment has been incentivized actually by the presence of infrastructure-based competition. If we look at the entry in the market in the Italian market by Open Fiber in 2016, this led basically Telecom Italia to want to invest in fiber as well, or to speed up its investment process, its investment in fiber. And to do that, by reducing costs, it has entered into a joint venture agreement with Fastweb. Therefore, Telecom Italia and Fastweb have Flash Fiber, which is the joint venture between Telecom Italia and Fastweb, has been spurred on, let's say, by the entry into the market of Open Fiber, and therefore we have sped up the fiber investment also by Fastweb and Telecom Italia. But this co-investment was actually just to reduce costs, because basically we created two separate networks. Joint Fiber is just a company which just deploys a passive fiber in the secondary network, and therefore creates two separate parallel fiber networks, one by Fastweb and one by Telecom Italia. So the result on the market of Flash Fiber is two separate fiber networks, which together with the other fiber network by Open Fiber actually creates significant competition in the fiber market. So again, co-investment does not need to lead to deregulation, because in say, if the effects of the co-investment lead to a more competitive market, then the NRAs we can evaluate if there's a need for deregulation. But based on the effects of the co-investment, not of the co-investment per se. I think it's interesting to note that in Italy, as a result of the outcome of the latest market analysis on the wholesale access market, Telecom Italia has been deregulated, partially deregulated with the price control obligation by, and also in Milano, it has been totally deregulated in the Milan area due to the presence of the fiber network by Open Fiber. In 26 cities, Telecom Italia has been partially deregulated with regard to the provision of active products because of competition by at least two other alternative networks. In this case, it's Fastweb and maybe Open Fiber. It's interesting to note that as a result of the deregulation, Telecom Italia, both in Milano and both in these 26 cities, has actually reduced wholesale prices, because there was a competitive pressure not to increase them because there were alternatives, which means that we have the paradox that we have competitive pricing, which are lower than regulated cost-oriented pricing, which is something that I think the regulator will have to address. But this means that if there is a competitive pressure even on the wholesale market, then the risk of increasing wholesale prices obviously will be reduced. The other investment, actually the co-investment that actually was not mentioned by Francesco, but I think it's interesting, is the one that Fastweb also made with Wind 3. We actually announced actually already undergoing a co-investment with Wind 3 to deploy a mobile 5G network. In this case, also, the deployment of it will be a deployment of one network by Wind, which will give Fastweb a slice of this network, a slice of the 5G network, so that Fastweb will be able to independently provide mobile 5G services as well. Again, this is another example of a co-investment which in the end reduces costs, obviously, but increases competition, because as a result, there will be a fifth mobile operator in Italy, which is Fastweb, which will manage its own, be fully independent in managing its own network. If we go to the third example of the co-investment, which is was mentioned by Francesco before, which is the INWIT merger between TIM and Vodafone. In this case, we are a little bit more concerned, because obviously we agree with the objective of decreasing costs, of sharing costs, but we are afraid that this could lead to less network resources be available for other operators in the market, especially in areas where, as I said before, in the main cities, there may not be alternative towers on which to deploy antennas. So in this case, which I'm not saying is the case yet, but there's a concern that it actually may reduce competition if access to the essential site is restricted by the merged entity.
1 more minute, please.
Okay. So basically finished. The message I wanted to convey was basically that co-investment obviously can contribute significantly to speeding up E&J investment, but there's not trade-off with either the regulation or less competition. I think the message is co-investment can help reduce costs and improve market conditions, maybe even make markets more competitive, and then deregulation will only take place if the co-investment has a positive effect on the market. And the incentives for the incumbents to invest is not deregulation, but rather competitive pressure by alternative networks. Thank you.
Thank you very much, Tiziana. Now we're going to move on to the Q&A. So we've had one question already in the chat, and I think a couple of questions came in by email this morning. But if I could encourage anybody who has further questions to put that in the chat. I'm going to start off, I think, with a question that I'm going to address to Felipe and Emily about the risk, the nature of risk. I think Emily said in her remarks, everybody accepts that fibre investments are large and risky. I wanted to ask for your observations on whether the risk faced by a new entrant is different from the risks as they might be perceived by an incumbent who already has a copper network and SMP. In the one case, the new entrant's counterfactual is not to have any revenues and not to have any costs, but an incumbent is upgrading from copper to fibre. And maybe one of the most effective ways of driving demand for fibre would, of course, be to turn off copper. So perhaps, which is at least partly in the control of the incumbent. So maybe I could ask Emily first and then Felipe for reflections on how regulators and others should think about risk. Is it the same for a new entrant and an incumbent, or is it different, and is it harder? How should that assessment work? May I maybe first ask Emily?
Yeah, absolutely. I think maybe this answer will not surprise you, but I think the differences may not be as big as they seem. And I say that for a variety of reasons. One is that the regulator in the UK, and I think this has happened in many other jurisdictions, has placed a lot of weight on opening up physical infrastructure. So if you like, the bottleneck that the regulator perceives to be all important these days is access to physical infrastructure at reasonable cost. And that's really aimed at ensuring that new entrants can deploy with the same kind of cost advantages as the incumbents. And that's incredibly important, I think, because it does have a very significant effect on their costs of deployment. I mean, the other thing you hear about potential advantages of an incumbent is that they have, in our case, a downstream retail arm, and that provides, a so-called anchor tenant. And one observation on that is that I see the market really transforming in terms of the degree to which large and sophisticated wholesale customers will entertain the notion of moving to other network operators, and for obvious reasons, because they can enter into long-term deals that give them pricing stability. They can shop around and get a really good deal for their fibre services, and that essentially breaks open the market and creates more anchor tenants. I mean, one of the terms that's used to describe Sky, for example, in the UK, is that it's a kingmaker. if a new entrant can sign a contract with Sky, then that will turbo boost its investment. So I think both on the supply and on the demand side, the playing field is a lot more level than perhaps it might seem at first blush.
Okay, thanks very much, Emily. And Felipe, what's your thoughts on that question?
I mean, I think the nature of the risks are going to be similar. Both the incumbent and entrants are going to be facing demand risk, cost and execution risk. They face competition risk. So at that high level, the categories of risk are going to be similar. But when it then comes to assessing each individual operator's business model or business plan, how those risks manifest are going to be different, right? So the position of a vertically integrated incumbent is going to be different to a wholesale-only fiber builder. Then the probabilities that one would assign to being able to secure or not secure different anchor tenants is going to be different. So the nature of the bet, if you we call it that way, is going to be different for an incumbent to an entrant. But the way you would analyze risk shouldn't be that different. You do need to take account of the specificities of each business model. And the reason why this matters is because there are scenarios out there in which, even though an entrant is currently not regulated, and it might sound a little bit far-fetched to suggest that a new entrant could become regulated. Fast forward 10, 15 years time, if investors are competing to be the first in a given area, there could be situations where a new entrant may find itself regulated in the future. And we may be asking the question, well, what was the nature of the bet for them today? What should they be price regulated, and if so, at what level? And the answer might actually be somewhat different. If a new entrant does become regulated 15 years from now, the nature of the risks they face today would have been different to an incumbent, and therefore the price at which regulation should kick in should also be different. Now, the difference would be that it currently, because an entrant is not regulated, it's only the incumbent that's regulated, then we can only specify, and the regulators should specify the nature of the fair bet for the incumbent that is regulated. And if further down the line an entrant becomes regulated, well, we'll have the debate at that point.
Okay, thank you, Felipe. I'm going to move, there's a question that's been asked from the floor about asking panelists to share reflections on the different rationales underlying the deregulatory aspects of the code in relation to both co-investment and wholesale only, and whether or not these should be regarded as equivalent, or whether they're very different in terms of the type of regulatory breaks that should be given. And I might widen the question to also cover different forms of co-investment that some of the panelists already spoke about. I'm going to ask that question first to Mark and then to Francesco for some comments on that. Mark first, please.
Thanks, Jeremy. Yeah, so I think if we think about 20 years of regulatory policy across Europe, the issue of discrimination, upstream, downstream discrimination, has been a sort of central to a lot of regulatory decisions, and the concepts of vertical separation of incumbents and all of the regulatory rules that go with that has been designed primarily to avoid exclusionary behavior or exclusionary effect by those operators with market power in the upstream market. So when we think about wholesale only versus co-investment agreements, they do fit into that framework in quite different ways. Co-investment projects are typically between players that compete in at least part of the market, either upstream or downstream. But typically they're people who are operators who are competing downstream in some way. And so you have to be, the rules around co-investment need to take account of the potential for vertical leverage exclusionary behavior. Whereas with a wholesale only network, that issue doesn't arise. And so regulators can be, it takes one of the issues off the table when one's considering about the regulatory treatment of these wholesale only operators. And that, thinking about it, that sort of simplifying the regulatory challenge has been one of the drivers for the regulatory drivers for separation. And if you take examples from outside the EU, like in New Zealand is the best example, where it's actually the whole way of incentivizing investment into fiber access networks has been built around a wholesale-only model. So I think they are quite different entities, and the regulatory treatments, a significant difference in the regulatory treatment of the two types of projects, I think, is warranted.
Thank you, Mark. And Francesco, what's your thoughts on that?
So, Jeremy, I concur 100% with what Mark said. Indeed, we have, as a firm, been involved in several projects with regards to the creation of wholesale-only models outside of the EU. But there are two instruments that try to resolve the same regulatory issue, and really the practical implementation of either is something that one will have to look carefully to determine which one is the right model to follow. I also don't want to dodge the question, Jeremy, but I think that Luigi has a thought on this particular point as I was listening to his presentation. So you may perhaps want to direct the question also to him.
Thank you very much, Francesca. I will certainly take your advice, and I hope Luigi will be willing to also share his thoughts. Luigi.
Yes. So I mean, I think the traditional wholesale access model is which basically reflects the principle of the non-discrimination and cost methodology recommendation. I think it's still one model that can very much answer to the requirement of bringing back some inflation into wireline markets, much needed inflation. So I mean, so that should be, I think, still the main the base case to keep in mind. I think that was the question, was it? Yeah.
Okay, thank you, Louis.
Jeremy, do you mind if I maybe provide a perspective on this?
Please go ahead.
So I must say I'm particularly a little bit puzzled by the wholesale-only business model reference in the code, in the sense that the code says that it should be treated more lightly and only be subject to fair and reasonable pricing conditions. Now, as I was alluding to in my presentation, I'm not sure there is any clarity in the code as to what fair and reasonable is, and the methodology that I described provides a perspective that also applies for vertically integrated operators. What is a fair and reasonable price of access for a vertically integrated operator? So I'm not sure whether, in fact, maybe it's a question for BEREC and other regulators to see whether they themselves know what fair and reasonable pricing for wholesale only would be that is different to what they would apply on a vertically integrated incumbent. I can only interpret this as being a potential incentive for vertically integrated operators to structurally separate voluntarily. But if that's going to happen, the only way for that to really take place is that there is clarity on, well, what's the price? How much higher can the price of access be if I structurally separate? And there hasn't been much clarity on that so far.
Okay, thanks for that. Yes, I would certainly say from a regulator's perspective that we always would want to set fair and reasonable prices. I think we never set out to have unfair and unreasonable prices, but what that means in practice and how much certainty we can give investors about what that means, as you say, is an important point. Actually, while we're on the subject of pricing, I was going to ask Tiziana to comment. There's a question about pricing, which is really, one is, there were two questions that came in by email. The first question was to do with whether pricing controls for VHCNs, if they're regulated, should they be based on cost-based pricing? Should there be flexibility? When should just a kind of margin squeeze, when should that change? And the second question was, how might different types of network be, pricing on different types of network be approached? If it was different technologies such as fiber or DOCSIS, or if there were different regional operators with different cost bases, how might that apply? So Tiziana, I don't know if you'd like to say something about your view on how pricing for these networks should be approached by regulators.
Yeah, yes, of course. I believe that basically cost models, obviously they should be cost, the main point is that they should be cost-based. It's very difficult, obviously, to distinguish new technologies where the scale factor is very significant. So we have a very high level sunk cost, and therefore the unitary cost depends also on the assumptions on demand and take-up. Therefore, my idea should be that obviously be a cost model which should be adjusted for demand. We have had some cases, for example, the recent case in which not specifically regards access, but regards into bandwidth, Agicom has actually developed a cost model to estimate the unitary price of bandwidth over the next 3 years, and therefore was cost divided by estimates of consumption. What happened in reality is that also due to the COVID emergency, but basically bandwidth consumption on fixed and mobile networks has exploded, and therefore the operators need more bandwidth, but the costs, which have been defined for 3 years by the regulators, are still high on a unitary level because they do not take into account the significant increase by like 100% consumption of bandwidth. So in these models, which in any case imply a certain level estimates of demand, I think the best idea would be to give the possibility to the regulator to review them and update them at least on a yearly basis in order to allow for effective costs and to take into account of the market of the demand of the demand side of the market. Flexibility could be provided, but we are personally, I'm always scared of flexibility, which is usually equals to discrimination. So I think that flexibility can be allowed for, looked into, but it should be transparent and non-discriminatory. So I think all these parameters have to check. Flexibility without transparency and always have to be reviewed by the regulator in order to ensure that it does not distort competition, does not favor either the incumbent retail side or a particular operator versus another. And on the other question of technologies obviously impact significantly the cost of providing access. So I think that prices should be differentiated by technologies. We're looking today at the next few years. I think 5G fixed wireless access will play a significant role, which with costs, which obviously we hope are significantly lower than FTTH with a similar performance. So obviously, actually in Italy, in the next few weeks, there will be a consultation on Telecom Italia's reference offer for fixed wireless access, because it could be a substitute for wireline access in case where there will be copper switch off. Agicom, the regulator, has allowed Telecom Italia to use fixed wireless access as a complement to NGA in a very limited amount when there is copper switch off, and therefore it will consult the next few weeks in the reference offer for Telecom Italia's wholesale fixed wireless access offer. And obviously, it will have different costs. We don't know if lower or higher, presumably lower, but definitely it should be differentiated by technology.
Thank you very much, Tiziana. We're out of time, so I had intended to ask each of the participants to make a short closing remark. But as we're out of time, I'm going to just restrict myself to asking Francesco if he'd like to say anything from the perspective of the IIC chapter chair, and then I'll make a closing remark of my own. Francesco.
Jeremy, just to thank everyone in the panel for such great contributions and making this discussion so interesting and rich, and to you for chairing it so marvelously.
Okay, thank you, Francesco. It's been a pleasure to chair it. I would also like to thank you and all the other panelists. I think in closing, I would recall some work that BEREC did last year on looking at some of the dynamics of investment in very high capacity networks. And in particular, one of the quotes that was said to the consultants who worked with us on that project, which is that investment happens when investors deem that the return is sufficient, not when regulators deem it to be sufficient. And I think that's really very much on our minds. Clearly, for investment to happen, there has to be an attractive business case for it. I think that there's been a lot of discussion about pricing controls. When might they be applied? What sort of controls should they be? And how can they take into account the risks? Of course, I think in my conversations with infrastructure funds, I think they would all be delighted to have SMP at some point. I think we have to remember that, of course, pricing controls only happen if people retain or acquire SMP. And so I think this is clearly going to be a topic that continues a lot of discussion, and I look forward to engaging with the panelists again and with any of the participants who also wish to put a point of view forward.